Hey folks, welcome back to Honey Money SG. In today's video, let's discuss the difference between CPF or Singapore Savings Bond SSB. Let's compare these two products and see which one is a more valuable product to put your money in. And before we go into the differences, let's talk about some of the similarities, right? Both of these products, whether CPF or SSB, gives you a guaranteed risk-free return. You know, when I'm talking about guaranteed risk-free return, I'm not telling you that you will never lose your money. Of course, if the Singapore government fails and collapses, which is a really slight possibility, then that's when you will never get to reach your capital. But are the chances really high or not? I'm not sure. It is possible. Yes, it is possible. But is it probable? Probably not, because if there comes a day where Singapore actually collapses and the government actually defaults on your CPF or your SSB, then I think you have bigger things to worry about. Most likely your investment portfolio have already failed you. Okay, the world is in catastrophe, apocalypse, everything is crashing down. Then that is the last thing that you may worry about, Singapore government collapsing. But you must recognize that CPF and SSB has always been quite a good place to park your money that is not used in your investment as a hedge, right? Just in case your investment portfolio really fails. So with that, let's go on to the differences comparing these two, starting with the interest rates. Now, I went through a lot on CPF on my channel, so you guys must be familiar by now. The CPF actually have 4 accounts: your OA, your SA, your MA, and your RA for those above age 55. Your OA will give you 2.5% interest, while your SA, MA, and RA will each give 4% base interest. Of course, you should know by now that your first $60,000 in the CPF actually gets you an additional 1% bonus up to 20k in the OA. But for the purpose of this video, I will just compare the CPF SA, right? Because that is really like the long-term retirement account, the long-term fund that you cannot touch until you reach age 55 and you have reached the full retirement sum. So I'm going to talk about the SA having a 4% interest rate, and that is actually fixed. For now, I must stress it really for now, because the government will periodically review the interest rates across the board over the quarters and see whether it is adjustable to the market. While the Singapore Savings Bond actually have a fluctuating interest rate. If we look at just the past month issue, there was a record high of 3% annualized over 10 years. And if we look at this month's SSB issue in September, it will be around 2.8% annualized for 10 years. But one thing to know about SSB interest is that their interest kind of fluctuates over the 10 years. Like your first year, you are getting around 2.6%, I believe. And then for the next few years, you are getting a bit higher than 2.6% just to make it annualized 2.8%. So it's quite different from CPF, right? CPF have like more of a fixed interest rate, whereby SSB, depending on which month you are issued the Singapore Savings Bond, will actually fluctuate year on year, but they come out to an annualized number that is reported every month. And for the purpose of the video, I'm comparing 2.8%, which is the September issue, which you all can go and apply using your internet banking portal right now. So 4% in SA versus 2.8% in the SSB, which one to pick? If you are just comparing numbers, then obviously 4% is much higher than 2.8%, right? But of course, later we'll talk about the liquidity and short-term, long-term kind of thing. But if we are talking about just numbers, CPF alone wins 4% versus 2.8% in SSB. Next up, we will talk about the compounding nature of these two products. CPF is actually a compounding interest instrument. In fact, if you actually start putting your money in CPF at the start of a year, it will start to compound and accrue interest, even though the accrued interest is not reflected in your month-to-month daily statement. But the fact is, at year end, when you receive your CPF annual statement, then you will realize that actually the interest started compounding since January. So it's like a month-on-month compounding, and that will eventually mean you get slightly higher than 4% because of the compounding in your special account. I think by now we all heard that compound interest is the 8th wonder of the world, right? So if you actually put in money there and you don't even look at it, if we talk about the rule of 72 and we calculate it, where it states like how many years does it take to double, we just take 72 divide by 4% the interest rate. It will just take you 18 years for your CPF amount to double. That sounds like a pretty sweet deal, right? 18 years just to double your amounts in CPF. And that is the magic of compound interest. But it doesn't apply to the SSB, you know, because SSB is actually simple interest, which means they will just return you the interest to your bank account or your SRS account, depending on where you apply for it. Okay, it will just return to you at the time the bond issues the interest. So there is actually no compounding to talk about once you have received your interest, unless you reinvest it in another investment such as bond or stocks. Then there is compounding effect in it. Otherwise, the interest or coupon payment will just be paid to your bank or SRS account and sitting like a lazy bum bum. Unless you go and reinvest it, then you can talk about it being compounding. Next up, let's talk about liquidity. And I know liquidity is a very touchy topic for CPF people, because when we are talking about CPF, there's really not much liquidity. It's really like a long-term retirement planning kind of thing. You will just park your money there and then expect it to compound the interest time over time until you have reached the eligible age to withdraw your CPF at age 55, provided you have reached the FRS. So there's really isn't much liquidity to talk about. It is just a long-term game. You're like an end game hero, you know, you're starting, your damage is really bad, okay, you don't earn much money, but at the end, if you really believe in CPF and park your money there, it will be an endgame hero, you know, your stats fly through the roof, your damage super godly imba. And I don't think there are any legal ways for you to actually withdraw your special account before you reach 55 and FRS. So it is really safe from creditors, from debtors, or people who are asking you for money. You can just say that I have no money because all my money is in CPF. That of course comes with the downside, right? Because let's say if you suddenly need capital to go and buy a house, start a business, go and do wedding, then you look at your CPF, okay, my CPF looks really rich, but my cash really poor. Then how? I think that just meant that you plan really poorly and not understanding your cash flow well enough to park some funds that are liquid enough. So don't blame the CPF for it, blame your own financial planning. And while we are talking about SSB, right, Singapore Savings Bond, although it is actually a long-term instrument, but it actually has short-term liquidity, because you can actually redeem your bond every month and it will be paid out by the next month, you see. For example, in the July issue of the Singapore Savings Bond, the annualized rate is around 2.7%, right? And then in August, people were really interested in it because the rates of SSB shot up to 3%. Then people will be enticing to apply for the August bond instead of the July bond. But you know what they could do? They could just apply for the August bond and then redeem the July bond because 3% higher than 2.7%. Then they use the same amount of cash to get higher interest. And that is the beauty of SSB. You don't have to be locked up until 55 years old. In fact, if you need cash flows for the short term, maybe you want to buy a house, do up some renovation, and you don't have enough cash on your hand, then you can actually redeem your Singapore Savings Bond even before the 10 years period is up. So it's actually more like a short-term instrument that has sufficient liquidity for you to tide over the next month. Of course, when you apply and redeem SSB, it must be in multiples of $500 at least. So you cannot like withdraw just $100, $200, multiples of 500. That includes 1,000, 2,000, 5,000, and 500, depending on what denomination you want it. I know you folks are tired of seeing Weibo ads because you are smart people. You have gotten your free Apple shares and free Microsoft shares since the last few months. But you know, there are still some people who are clueless and haven't got their free stocks from Weibo yet. So this month, Weibo is actually offering you $100 worth of Google shares once you have deposited $1,965 and make 6 buy trades. The other condition is that each buy trade has to be at least 100 USD, and the condition is that you have to hold your $1,965 for at least 30 days until the stock voucher is credited. But you may ask, why such a funny number, $1,965? It is to signify Singapore's years of independence since 1965. Happy National Day, and as a channel with SG in its name, very proud to be a Singaporean, so I hope that this $100 worth of Google shares can make your day better. And that is so we can be stronger. Majula. Next up, let's talk about max limit that you can hold in both accounts. So for CPF, I think it's quite clear cut. The max limit is actually in your full retirement sum that you can top it up with. I'm not talking about mandatory contributions from your employment. I'm talking about self top up, voluntary top up, and voluntary contribution. Let's say if you really love the tax relief, although it's capped at $8,000 per year, but you can only top up to a limit up to the FRS, the full retirement sum. And for the purpose of full retirement sum in 2022, that is 192,000. So above 192,000, you cannot top up anymore and cannot enjoy that tax relief. Then for Medisave account, your MA, the limit is up to the BHS, which is 66,000 for the year of 2022. So likewise, you cannot top up above the BHS because all these things will be rejected and then will be refunded to you at no interest. While for the Singapore Savings Bond, you can actually apply for Singapore Savings Bond up till the max of 200,000 Singapore dollars. So let's say you actually applied for a previous tranche, maybe you are allocated 10k, then you will still have $190,000 worth of SSB that you can buy, because once you have hit your max limit of $200,000, you can no longer apply for any new Singapore savings bond unless you have redeemed your previous issues. Lastly will be on the tax relief, because it depends on whether you are doing a top-up or voluntary contribution. If you are doing like a RSTU, retirement sum top-up to a special account, or even voluntary contribution to your Medisave account, you are entitled to up to $8,000 of tax relief per year, and that will offset your taxable income and ultimately reduce your tax expense at the end, depending on what's your tax bracket, right? So if let's say you are like a 7% tax bracket, a $8,000 reduction in your taxable income, that is 8,000 times 7%, which is $560. Pretty good, right? Guaranteed tax relief, and you save $560 per year. And if we jump over to the Singapore Savings Bond side, there is no tax relief if you actually buy it with cash, but there's tax relief if you actually use SRS to purchase. And I talked about SRS previously on my channel before. It's basically like a deferral tax scheme that allows you to actually defer your taxes up to the age of 63 right now when you decide to actually withdraw it. And it is definitely a tax advantage account, because whatever you withdraw from your SRS is taxed at 50% instead of 100%. And by the retirement age of 62 or 63, then maybe you do not have so much income anymore. So the income tax applied is actually much lower. So if you want to voluntarily contribute or top up to your CPF, that is $8,000 of tax relief. And then for your Singapore savings bond, if you want to buy it using SRS, it's up to $15,300 for Singapore residents. For foreigners, I think it's around $36,000. So you have a much higher tax relief cap for foreigners. Alright, wrapping up, the CPF versus SSB debate has been ongoing for some time, and I feel that these are some of the factors that you should look at when you're comparing whether you should put your money in CPF or SSB. Ultimately, I feel that CPF is more of a long-term thing. You really believe in the CPF system and you want to be an endgame hero, whereby SSB is more for short-term funds where you want to park some emergency cash, your 6 months emergency savings in there. I think you can put in the SSB. But then for long term, you can put in the CPF. Both of them have their own tax relief limits, which I have talked about. So you must own self go and calculate, see which one is a more suitable option for you. And if you want to look at my thoughts of whether you should invest your SRS or you should just buy the SSB, then you can refer to my previous video on investing SRS, because I stopped it with that. Thank you for watching. My name is Christopher. This is Honey Money SG, steering young adults to financial independence.